Hello, good evening.
Good evening.
I guess we had a very fruitful day. Okay. So, as our practice is, before we start today's
Yes,
session,
please.
we want to do a recap of what we studied the last time we met. So, Ramatu, if you can do us the honors by reminding us of what we studied the last time we met. Okay, if Ramatu cannot hear me, Derek. Hello, Derek.
Hello, sir. Please, the question again.
I want somebody to remind us of what we studied the last time.
Okay. So I'm actually at
We
work.
take charge of
I'm in the middle of
assets.
something, but let me try and recap on what we studied last Saturday.
Okay.
So basically,
Derek, you are muted. Okay, Alberta.
So I said we did charge over assets. We went through the release, the sale, and all that.
Hello, good evening, Ima.
Yes, sir.
So hello. We have also it was recovery of unpaid tax from taxpayer. We did sale of the charge assets, and then we also did release of charge of assets, restraints of a person, and restraining others. So you made mention that recovery of unpaid tax from taxpayer can be done through creation of charge over assets, and then through commission can also use restraining of the person or restraining others.
Okay.
So under that we had the various discussions.
Okay. Then we went to recovery of taxes from third parties.
Yes, please. That was I think, and then refund.
Okay.
Recovery of, yeah.
Okay, that's fine. So today we'll be looking at a new topic. Unfortunately, I am a little under the weather. So my colleagues, Mr. Musa, will be taking us through the lecture today. Mr. Musa.
Oh, sir, we wish you speedy recovery.
Thank you, Alberta. Hello, Mr. Musa. Hello, Mr. Musa. It appears he cannot hear me. Hello, Mr. Musa. If you can hear me, please take over now. Okay, so Mr. Musa is back online. He will be taking us today on a new topic. Just as you have been giving me the maximum cooperation, I pray that you do same for Mr. Musa.
Good evening.
Good evening.
Good evening.
So,
Evening.
Mr.
Please,
Musa,
can you hear me? Or
your
you
students.
can't hear me?
I hear you
I want to hear
clearly,
it, get a
loud
feedback.
and clear.
Great, great. So, enjoy this lecture, okay? Thank you very much.
Hello.
Hello, sir.
Hi.
Hi.
Hello.
We can hear you, sir.
Okay, so that's great. That's great. So today, as my boss Emmanuel have already made the like done the introduction of the tutor for tonight. I think I'm stepping in for us to go through fiscal policies and then the tax implications when it comes to fiscal policies in Ghana per the new syllabus. So as he made mention, my full name is Musa Crispinos Piba. So without wasting much time, we'll just go straight to what we're supposed to do today. But by then, maybe if somebody has a question on whatever that was taught last week, you can let us know so that we handle it before we proceed, please. If there's no question, let me get a response whether or not I move. Please, can I move on? Or you have anyone having a question?
You can move on, sir.
Okay. So let's say a word of prayer before we continue. Heavenly Father, we thank you so much for today. Lord, we thank you for this evening. Your children have gathered again to discuss principle of taxation. Lord, we pray that you give us the strength, you give us the understanding. That, Lord, whatever we're going to discuss here, the day of accountability, Lord, that same thing will come and we'll be able to remember to produce relevant materials that will meet the requirement of the examiners. And at the end, we shall come out with flackerless. And Lord, we shall gather again to give you thanks and give you glory. We'll pray in the mighty name of Jesus. Amen.
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 Yeah. So,
Amen.
yes. So, today we will look at fiscal policies. We'll look at the type of fiscal policies and the instrument of fiscal policies. Fiscal policies, as we always hear with the Minister of Finance of fiscal, when the budget is being read or when he's preparing for to appear before Parliament to present the budget, we always hear of fiscal policies. So we'll look at what fiscal policies are, the type of fiscal policies, and the instruments of fiscal policies. And we'll look at other areas as we progress. So fiscal policies, as I made mention, is simply how government uses revenue and expenditure activities to influence the direction of what? The economy, or in order to achieve a certain state objective. Because it's more or less how, so every year, the government, per the constitution, which is always represented by the Minister of Finance, has to tell us how the government of Ghana is going to raise revenue, how he's going to spend. So that is why we have the definition of fiscal policy being how the government is going to use this revenue and expenses or expenditure to be able to influence how the behavior of the economy should look like. Or government can use this revenue or expenditure to direct the economy into a certain circumstances to be able to achieve some stated objectives. And what are the objectives that the government can be able to use this as a physical tool to be able to achieve? We are looking at full employment. Government can use this to be able to achieve full employment or create employment. Second is to increase aggregate demand, to combat inflation, and to secure rural-urban imbalance. So to also increase economic growth and promote economic development. So government can use these fiscal policies to direct the economy in such a way that all these objectives are being achieved. And as I made mention, per the constitution, is the Minister of Finance who represent the government to do, so the budget will be prepared based on the budget estimate, which is submitted to the cabinet for approval before the budget is presented to Parliament for approval. We're not doing public sector, so I wouldn't go much into how the budget, the public financial management cycle, how it's been prepared. But what you are supposed to know for the purpose of taxation is to know what fiscal policy is. As I explained, it is how government uses her revenue and expenditure activities to influence the direction of the economy. And government is doing this basically to achieve some objectives. And I mentioned few of those objectives is to create employment, to combat inflation, to increase economic growth, and promote economic development. So, as I made mention, the main fiscal tool is the government budget. The main fiscal tool is the government budget, which I made mention. And the budget is a blueprint of the government expected revenue and expected expenditure for a financial year. So every year, the Ministry of Finance will be, from the budget, tell us how government is going to raise revenue. Is it that he's going to increase taxes or come out with new taxes, or is it that he's going to borrow? And the borrowing, we have the domestic borrowing and we have the international borrowing, whether we are going to IMF or we are going to the stock market. In the budget, all those things will be explained. And even in the budget, it will be explained how he's going to manage those debts. So that is why we are saying that the government budget is a blueprint of government expected revenue and expenditure for a financial year. So when we are saying a financial year starts from 1st January to 31st December in a particular period. That is the calendar year. For example, 1st January 2023 to 31st December 2023 will be a financial year. So in taxation, if we are saying financial year or year of assessment, we are referring to the calendar year. So this budget, as I made mention, we can either have a surplus budget or we have budget deficit. And in taxation, when we arrive at a budget deficit, it means that we can term that as constructionary fiscal policy. Constructionary fiscal policy. And if we are arriving at budget deficit, we can call that expansionary fiscal policy. And where a situation where we are able to achieve a balanced budget, then we can call that moderate policy. Moderate policy. So these are the various, and I can say that Ghana, I can't remember the last time we have recorded either being it a balanced budget or budget surplus. It's always budget deficit, budget deficit. So which it means that that is the expansionary fiscal policy when it comes to taxation that Ghana basically we experience. So please, I will pause here. If I have a question, I'll take it before I move to the impact of government and central bank fiscal and monetary policy. Basically, we are going to look at what fiscal policies are and what monetary policies are. So please, if you have a question, let me pause here and then take it before I move on. Please, let's make the class interactive, because this area is an examinable area, because you get this when you move on. Probably those doing public sector, you also see this in there, but we are looking at the tax aspect of it. So please, if you have a question, let me take it before I move on. Please, any question for me? Or I can move on.
Yes, sir. Please, you can move on.
Okay. So as I explained earlier, now we're now coming to look at the impact of government and central bank fiscal policy and monetary policy. So this is basically what you call the monetary policy sits with the Bank of Ghana. The monetary policy sits with the Bank of Ghana, and the fiscal policy sits with the government, which I made mention is represented by the Minister of Finance. So now, the monetary policy, it is the process how the bank, the central bank, that is the Bank of Ghana, manages the money supply and interest rate to achieve macroeconomic objectives. Macroeconomic objectives, where if we make mention of macroeconomic variables, we are looking at the inflation rate, the exchange rate, as it has been set when the fundamentals are weak, the exchange rate will expose you. It's basically this, and this is with the Bank of Ghana, that is central bank. They manage or control the supply of money and the interest rate. That is why we always in taxation, as we are moving on, when you get to computation of interest or probably penalties, you heard us mentioning of what Bank of Ghana root discount rate or Bank of Ghana monetary rate, because it is Bank of Ghana that comes out with this monetary rate. That is why we are saying that fiscal policy is just a procedure or a process by which a central bank, that is Bank of Ghana, manages the supply and interest rate to achieve macroeconomic variables. The reason why they are managing this is to achieve, the main objective is to achieve macroeconomic objectives. For example, control inflation, manage employment levels, and maintain financial stability. That is why when the exchange rate is not going well, they are always on either the Bank of Ghana or the Ministry of Finance. So we have some main tools of monetary policies, which I want us to look at. We have the interest rate being one of them. So the central bank, which is the Bank of Ghana, influence the short-term interest rates through their policy rate, which I made mention of, that this rate comes from the Bank of Ghana, and they influence and they come out with short-term interest rates. Lowering interest rates make borrowing easy. So if That is why when the Bank of Ghana comes out with the interest rate, the banks have to comply. So if myself and you go to the bank to take a loan, you see that now they will tell you that 4% either per month or weekly. And when you multiply that by the days in the month, and you try to move that to a year, you see that you are paying so much. And this comes from Bank of Ghana. So lowering the interest rate easily, it makes borrowing easy, so that myself and you can go for a loan and pay a lower interest rate, which in turn encourage investment and consumers spending. Because if we're able to borrow a loan at the cheapest interest rate, we'll be able to invest. Small scale, medium enterprises can go for loans to invest in their businesses. It will increase our spending. We'll be able to, we'll have our disposable income will now be high. So it will increase our spending. It will stimulate economic growth. So the economy will be booming. It will do well. And on the other side, when there is a high interest rate, it makes borrowing more expensive. It makes borrowing more expensive, which in turn slowing down inflation and cooling overheated economy. For example, if the economy is not doing well, So let's look at another one. We'll look at the main tools of monetary policies. I made mention one being the interest rate, second being open market operations, which basically the central banks sell government securities in the open market to influence the money supply. And you see, this has to do with the T-bills and other government securities, being it bonds, where the Bank of Ghana will issue the securities, and the citizen will buy. The citizens will buy that, which means that buying the securities inject money into the economy, increasing the money supply and lowering the interest rate. And they can, when they are selling, it means that they are also withdrawing money from circulation. That decrease the supply of money, or rising the higher interest rate. So it means that the government can actually use this through the Bank of Ghana to direct the economy. That is what we are looking at. We are looking at fiscal policies, and we are saying that fiscal policies is how government, that is government of Ghana, is able to use her revenue and expenditure activities to influence the behavior of the economy. So you see both sides. If you are buying securities or you are selling securities, how government can be able to use that to influence the direction of the economy. We are looking at the reserve requirement as one of the main tools. And this tool indicates the minimum amount of reserve a bank must hold as against what? Deposit. And all of us were in this country where when they were doing the banking cleanup, the capital requirement was 400 million Ghana cedis. And I can tell you some of the banks collapsed because they were not able to meet some of this capital requirement. And some of them, they have to downscale them from bank to savings and loans because of this. So all this comes from the Bank of Ghana. That is the reserve that a bank should hold as against its deposit. So that is basically the main tools of monetary policies. If there's a question you can ask so that I'll take it before I move to the impact of these monetary policies that we can experience as a country. Impact of monetary policies as a country. So please, do you have any question for me?
So I think at this point, no question, we are assimilating.
Okay. Please, Senior Ima, is the section recorded for them later, or I just remembered. I don't know whether you have done that.
Yes, it's being recorded.
Okay.
Sure.
Okay, that's fine. So let's look at the impact of monetary policies. Impact of monetary policies. So now we know what monetary policies are. Some of these things should be in our fingertips, because when we go to public sector accounting and finance, it is there. When you come to principle of taxation, it is there. So we have to know all this. What they say, monetary policies. What are monetary policies? We have main tools of monetary policy, which I made mention: interest rate, the open market operations, all of them. You have to know them. Now, there's an impact that these monetary policies have, and one is economic growth. Economic growth. And when we make mention of economic growth, we are referring to the expansionary monetary policies. Expansionary monetary policies. That is low interest rate. And I made mention that if there's a low interest rate, we are able to borrow money at a reduced interest rate. That money will be able to use to invest, and we'll have more to spend. So it means that it will increase our consumer spending. So in nutshell, this boosts economic growth by making credit more affordable, therefore stimulating what? Investment and consumer spending. Another impact is the inflation control. Inflation control. And we are referring this as what? The constructionary monetary policy. Constructionary monetary policy. That is where the interest rate is high. When the interest rate is high, it helps control inflation by reducing consumer spending and investment. Because if there is a lot of money in the system, then high interest rate will what? Make it very difficult to actually go for loan. Because if you go for loan, it means that you'll be paying the interest at a higher rate. It is a way of controlling inflation, which will in turn reduce the consumer spending, because it will make consumers will not have the disposable income will not be enough for them to spend so much, and then businesses will not be able to borrow money to finance or invest. The next one is employment. Low interest rates actually lead to what? Employment, because businesses will invest these monies that they go as a loan to expand their business, which will increase demand. So as demand increase, it means that they will be able to employ individual, myself and you will be able to get work to do, because the business is doing well. The business have been expanded. And with what? There will be keeper credit. So that is a way monetary policy can impact on the economy. We're looking at another one we'll also look at is the exchange rate. The exchange rate, this relates to what? Change in interest rates affecting exchange rate, which in turn impacting international trade by making export cheaper or more expensive, whichever ways. When you are looking at it at high interest rate, it makes it more expensive. If you are looking at it within the low exchange rate, then it makes it very cheap. So that is what we are looking at when we are trying to explain the impact of monetary policy on the economy. We are looking at the economic growth, we are looking at inflation control, we are looking at its ability to create employment, and exchange rates as a final point. So please, if there's no question, permit me to go to for us to look at the fiscal policies. So that is the monetary policy aspect, which I made mention that that one sits with the central bank, that's the Bank of Ghana. So the fiscal policies involve basically the use of government spending and taxation to influence the economy. The use of government spending, how government spends, and how government raises revenue through taxation to influence the economy. And this primarily is managed by the government rather than the central bank, which I told you that the government is basically in charge of the fiscal policy, but it is being championed by the Ministry of Finance. That is why you see the Ministry of Finance presenting the budget to Parliament. We in public sector accounting and finance, we have something we call the policy strategic document. That's the Ministry of Finance always prepare and submit to cabinet for approval. That will enable them, and in that document, all these ones will be spelled out to be able to come out with, to collate all the budget estimates from the MMDAs and MDAs. And when the budget, the final budget is being put as one, then the president must sign. So it means that the Minister of Finance go to Parliament on behalf of what? The president. That is why this guy, what is the name? Dr. Bawumia said the budget does not go to Parliament in my name. The budget go to Parliament in the name of Akufo-Addo. So you see that is why I'm saying that the fiscal policy sits with the government, but it is the Ministry of Finance who champion the fiscal policy. So the fiscal policy can also be broken down into expansionary fiscal policy. Expansionary fiscal policy. If we say expansionary fiscal policy, what basically are we looking at? That is increasing what? Government spending and reducing or decreasing taxation to stimulate economic growth. Please don't forget what is the main focus. We are looking at fiscal policy. And what do we say fiscal policy is? Fiscal policy is how government uses her revenue and expenditure activities to direct the behavior of the economy. So let's look at expansionary fiscal policy. What is it? We are saying that it is how government increases what? Its spending. Or he either what? Reduce taxation to stimulate economic growth. So whichever angle, you'll be able to steer the economy either to left or right. That's what we're looking at in simple put. So it is basically used during period of recession or economic slowdown, if the economy is not doing well. And you see, basically what happening in Ghana right now, the economy is not doing well. So government have to either use one of this, and you can see that government expenses is going, we'll come and look at that, it's increasing, but taxation is also a challenge. If government have to use the expansionary fiscal policy, it means that he should have what? Increase spending and lower the taxation so that he can stimulate economic growth, so that the citizen can be able what? To afford, so businesses can survive. Okay, so let's look at the constructionary fiscal policy. That is where you appreciate what is happening on grounds when it comes to economic fiscal policy. So when we're saying constructionary fiscal policy, we're looking at government decreasing what? Its spending or increasing taxes to reduce inflationary pressure when the economy is what? Overheating. So that's the two basically two types of fiscal policy. The expansionary, which says that government will increase its spending or reduces taxation to stimulate economic growth. And the constructionary fiscal policy is saying that government decreases its spending, increase taxes to reduce inflationary pressure. And you now ask yourself, which of this does government of Ghana actually is practicing? Because we are increasing a lot of taxes every day. We have exorbitant taxes all over, and then we are also having unnecessary spending all over. So you see that I can say that we are using a mixed, but that is not what we are looking at here. For the purpose of ICA exams, our duty is to give you the knowledge for you to be able to pass. And then when you pass and now come, we'll be able to relate this to what is happening is in the real case. If it were to be a public sector paper, some of discussion will be much of importance. So please, let me go straight to the impact of fiscal policies. We look at, when we're doing the monetary policy, we were able to explain the impact. Let's also look at how the fiscal policy will impact on the economy, impact of the fiscal policies. And we're looking at aggregate demand. Aggregate demand. And what does that mean? It means that the expansionary fiscal policy increases what? Aggregate demand by boosting government spending and increasing disposable income for consumers. Because if they reduce, don't forget, the expansionary fiscal policy is that government will rather increase his spending and reduce taxation. And when taxation is reduced, myself and you, our disposable income will increase. So we'll have a lot of money with us. Once the constructionary fiscal policy, aggregate demand will reduce, because if we have more money, we'll be able to spend, our consumption rate will increase. But the constructionary fiscal policy is saying that governments reduce its spending and rather increase taxation. So if government increase taxation, it means that it will affect our disposable income. Hence, it will reduce what? Aggregate demand. Hence, it will reduce aggregate demand. So that is one aspect of the impact of fiscal policy. Another one is economic stabilization. This is a basic economics in the secondary school. And basically, this is to help stabilize the economy during business cycle, during difficulty, if the economy is in recession. And basically, what are we talking about, for example, is to increase spending during recession. This can help reduce unemployment and stimulate the economy. That is one of the impacts of fiscal policy. Another one is redistribution of income. And that is why Ghana were using the progressive taxation. I'm sure if that have not been treated, or if that is looked at, you can get a question to be, they can ask you a question to explain and select the best tax system for either Ghana Revenue Authority or for a country. And we are looking at the direct and indirect. We are looking at the progressive and regressive. And then Ghana, we're using the progressive. What basically it means is that those who earn more, we tax them to what? To help. So that's why we say pay as you earn. The more you earn, the more you pay. The lesser you earn, the lesser tax you pay. So we are taxing the more to support the poor. That's the basic understanding of progressive taxation. And social welfare programs. Fiscal policies can also help to reduce income inequality. That's why we're using the progressive. We'll come and look at social importance of taxation. And one of them is to check the lifestyle. So if we see that we are living a luxurious lifestyle in the community, then it means that you will be required to pay high taxes so that we'll be able to use it to support the poor. When you finish and you come to the final level to meet us for advanced taxation, we have something we call the net worth, which GRA always use to determine taxes in cases where you are not putting proper recourse, and then you are declaring either losses or something like that, and you are driving G8 everywhere, the GRA is obliged to use the net worth methods to assess you to tax, and you are abandoned on that assessment. So please let's go ahead. The last point on the impact of fiscal policy is public debt. Excess expansionary fiscal policy can lead to high public debt level if not properly managed, and impact long-term economic stability. That is what is happening in Ghana. Because we are seeing that government to the expansionary fiscal policy is where government increases its spending and reduces its taxation. Now, if that happens, it means that government is going to spend beyond what the government has. And in effect, or indirectly, it means that government has to borrow to finance its activities, because what the Ghana Revenue Authority gives government is not enough, because this policy is saying that increase government spending and reduce taxation. So if we go and borrow, and we are now resorting to higher public debts, and if it is not properly managed, it will impact on our long-term economic stability. And that is what is happening in Ghana, because we have crossed the red line. Ghana, our reputation is damaged. No country is willing to borrow us. You heard of Cocoa Board. Any place they go, they don't want to give them loan, because Ghana is highly risky when it comes to public debt. So please, I'll pause here. If there is a question you ask before I go ahead. Please, this area was examined by ICAG. It was examined by ICAG. Let's take note. I've put some of the past questions for us to look at after the class to appreciate whatever we are doing. So please, I would like to take a question before I look at the type of fiscal policy, that the discretionary fiscal policy and automatic stabilizers. Please, do you have any question for me? Hello?
No, sir.
Do you have any question for me? Please, can I move on, or you have a question for me? I always want to get a response.
Please, you can move on, but
Please move on.
yeah, like if you can maybe take your time a bit. I feel like you are being like rushed,
I'm going
so
fast.
yeah, you are rushing. Yeah, you are fast.
Oh,
Maybe
okay.
because
Okay,
we've
no
had
problem.
slow teachers who take it slowly, so maybe we think you are going faster. I think, but I don't know the rest of the
Oh,
team.
okay. That's a good feedback. You have to, because
Alberta, we support you.
hey, okay, no problem. I will take it slow. That is why I always need a feedback from you, so that. So it means that we can continue with it, or is it something that you didn't get and you want me to explain?
We can continue, sir.
Okay. So let's look at the two types of fiscal policies. One is the discretionary fiscal policies. This deliberate change in government spending and taxation to influence the economy. So it means that when there is maybe if the economy is unstable, or if the economy is on recession, then government will come in to stabilize it, or government will come in to change the direction of the economy. That's what we mean by discretionary fiscal policies. It basically involves the intervention of policymakers or government For example, that's basically to what? To either boost demand during recession. Please, if you get the discretionary fiscal policy well, then the second one should be easy for you. I'm saying that the discretionary fiscal policy involves the intervention of policymakers or government. That is the use of what? Government spending or taxes to influence the economy. So if for example, if the economy is not doing well, the government can come in to either increase its spending or lower taxes to stabilize the economy. So the discretionary fiscal policy always involve the intervention of government or fiscal policy, what do you call
Go right and turn left.
policy makers.
You're welcome.
So when it comes to the automatic stabilizers is the opposite of the first one. The automatic stabilizer simply means that automatically, if there is any recession or the economy is not doing well, the demand and supply would stabilize it, will bring it to equilibrium without the intervention of any legislative action or without the intervention of the government or intervention of policy makers. So it is built-in mechanisms that automatically adjust the economy to be at stable. So, for example, if things are not going well, prices in the market, government cannot come in, government cannot intervene. It means that this automatic stabilizer, demand and supply, will set the price, will bring the economy back to normal. So that is basically the meaning of what? Automatic stabilizers. It does not involve the intervention of government or policymakers. For example, let's say unemployment benefit and progressive income taxes that increase with what? High income levels. So if, for example, if there is high, let's say unemployment, and then we are using what? The progressive taxes, it means that what we are saying is that those who earn more should pay more, and those who earn less should pay less. By way, it will what? Bring back, try to neutralize or try to bring the economy back to normal. So that is basically the differences between the discretionary fiscal policy and the automatic stabilizers. ICAG asks students to explain what or the differences between discretionary fiscal policy and automatic stabilizers. Please, so let's take note. Please, is this okay, or you have a concern? I'm talking about the speed, and then maybe if you are not clear, you let me know before I proceed.
Hello, sir.
Hello, go ahead.
Sir, I'm getting a bit confused, but I think maybe later when I go back to read, it will be clearer. With the fiscal policy, you made mention that government uses its revenue and expenditure activities to influence the behavior of the economy.
Yes.
And with the monetary policy, it is a process by which the BOG manages the money supply and interest rates to achieve macroeconomic objectives. What I want to know is, are their activities intertwined? As in, do they work together or they work independently? The reason why I'm asking is, when you check the activities of the fiscal policy, We are looking at objective full employment. So let's take it that maybe based on the activities, there's so much money in the economy for people to spend.
Yes.
Or maybe I'm not getting it. That's what I'm saying. That I'm a bit confused with the two.
No, you see, go ahead.
Even asking the question, Graham, I don't know. With employment, full employment under fiscal policy, the objective, and monetary policy too, the activities that they do, we are using that to control the money supply. So what I want to ask is, when you use the example of interest rates and borrowing, you said that when interest rates are high, that means it will reduce the borrowing power of people. People might not be able to borrow much, and that may end up affecting the money in the hands of people.
Yes.
I don't know if I'm right.
Yes.
Okay. So now, when you count that, there's going to be an effect on employment because businesses will not be able to borrow as they are expected or they want to. So at the end of the day, they might not be able to employ more people.
Yes.
So it's going to be a negative effect on employment over them.
Yes.
But when you come to fiscal policy too, I'm seeing something like employment here. I want you to pick an example under fiscal policy that relates to employment. And when it comes to monetary policy, that relates to employment. So that I'll be able to distinguish the two in case of explaining.
Fiscal policy. So so basically what you are the net effect is that under the fiscal policy, it sits with the government. Do you get it? So as you were so for example, if government increases taxation, it means that I think when we progress down, you'll be able to get it. But let me explain. If government increases taxes, do you get it? It means that businesses, the profit that they would have been able to plow back to expand their business, they will not be able to do that because they are hit by what? High interest rates. For example, when you take the VAT for example, the VAT you are required to pay irrespective of whether you have made profit or not. So these businesses, one way or the other, will not be able to do well, which in turn they will not be able to what? To employ, which will increase what? Unemployment rate. Or another way is that if, let's say, the prices of input, that is the raw materials these companies or these enterprises use, if the prices of input increases, it means that they will not be able to what? To buy more to be able to produce, which means that productivity will be affected. Do you get it? When you come under the monetary policy, the interest rate is something that when you look at the capital structure of a business, it's made up of the equity and then borrowing. So for us to be able to finance, for us to be able to expand, we will need additional capital. And the additional capital will rely on what? Borrowing. And this is the case, that sits with what? Bank of Ghana, that's the central bank, which control this interest rate. So let's say in instances where there is a high interest rate, we will not be able to borrow to expand our business or invest. In effect, we will have to even lay out workers because we will not be able to cover our operational expenses or costs. Hence, high employment rates. On the other side, if there is low interest rates, it will have effect on what? The business, which it will in turn what? helping them to what? To engage a lot of unemployed graduates. Please, I don't know whether the explanation is clear.
It's clear. It's clear. But I want to just ask another thing. Why do you keep on saying under fiscal policy, the government, but when it comes to monetary policy, you still emphasize on BOG? Is BOG not part of the government?
BOG is part of the government, but don't forget, when I made mention of government, my first submission, I said that it is the finance minister that championed that.
Okay.
On behalf of the government. It means that BOG also championed that on behalf of the government. And don't forget, BOG, the BOG all goes under the Ministry of Finance.
Sure.
Yes.
Okay.
But because we are looking of them, this instance, we are looking at them as independent, or want to get a clarity or a distinction between fiscal policy and monetary policy. I don't know whether I've answered your question.
Okay, I appreciate it.
Come again.
So thank you. I'm grateful. Thank you. I'm okay now.
Okay, thank you. Please, any other question for me before I proceed? If there's no question, let's look at national and public debts and their implication on the national economy. So when we are referring to national debt, it's basically the total amount of the total amount of money the government owe to its creditors. And basically, public sector accounting and finance, they'll say the total amount owed government plus all public guaranteed debt. Total amount owed government plus all publicly guaranteed debt. What does that mean? It means that any government, any covered entity or any entity that government guarantee for that entity to go for a loan, it means that if the person default, it forms part of what? The national debt or public debt. That's why we're saying it is the total amount of debt owed government plus publicly guaranteed debt. And when we are looking at public debt, we are looking at both domestic and internationally, because government can borrow domestically or borrow from international. Government can borrow from what we call the commercial banks, or go to World Bank or IMF to borrow. That's why I'm saying that government can either borrow domestically or internationally. So a simple put is that it is the total debt owed government plus publicly guaranteed debt. Publicly guaranteed debt. And I've explained what is meant by publicly guaranteed. So let's look at the implication of this public debt on the economy. High interest payments. High interest payment of debt increase government interest liabilities, which will affect its ability to expand in other areas. It will surprise you that we actually borrow to pay expensive debt, or we borrow to get, let's say, if we are owing let's say USA, for example, where we are paying a high interest rate, we can get a loan from China that probably will be able to pay a lower interest rate. China, we can just contact China to what? To pay off, to contact China to give us a loan to be able to pay off what? USA, and then we'll be able to deal with China to paying the low interest rate. So in instances where we have high interest rates in the economy, it actually affects government ability to what? To develop other areas like the education sector, the health care sector, the infrastructures, among others. So that is the implication of high public debt on the economy. high public debt on the economy. So we have the crowding out effect. What is this simply means? What is saying is that high public debt can lead to a high interest rate as the government compete with what? The private sector for borrowing. This happens locally. For example, if let's say the government goes to GCB to borrow, and then any private enterprise also goes to GCB to borrow, because if the rate that they will give to government, it's the same rate they'll give to what? The private enterprises. It will end up what? Tend to be a competition between the two, which at the end, the government will be able to kick out the private person, and it will affect private investment, which will lead to what? Slow, because the economy is being operated by the public sector and the private sector. So the two have to do what? To be able to do well. That is why in public sector, we are looking at the 3 E's. So that is basically that. Please, I'll pause here. If you have a question, then you let me know before I proceed to inflation rates under the implication of public debt on the economy. Please, can I move on? Hello.
So please, the crowding out effect, I didn't get it here.
Yes, what I'm trying to say is that high public debt can lead to what? High interest rates. And we're saying that I made mention of government borrowing domestically. And how will government borrow domestically? It can borrow from the commercial banks. So if government go to Ghana Commercial Bank to borrow, and let's say Musa Enterprise also go to Commercial Bank to borrow, it will end up being a competition between Musa and then the government. And then in effect, it will, because government, let's assume that if government can afford, let's say, interest rate of 72%, there's no way Musa Limited, being an enterprise, will be able to service an interest of 75%. So in effect, it will what? Lead to what? Pushing the private investment gradually out, or trying to what? Make it very difficult for the private sector to what? To borrow, which will lead to what? Slowing down the economic growth. Because government, it's now government competing with what? The private sector individuals or the private sector companies in terms of borrowing, because all of us need money to finance our activities. Please, I don't know whether you get it.
Yes, sir, it's cool now.
Okay, thank you. So let's look at the inflationary or inflation rates. Inflation rates. If the debt is financed by printing more money, it can lead to inflationary pressure. And this is what recently, if our political flag bearers have been mentioning that the Bank of Ghana have printed so much money to support this government. That is why today when you go to the market, the prices keep changing. Something you bought 5 cedis, you go, they say 10 cedis or 20 cedis. Because if the debt is financed by printing money, this leads to inflationary pressure. This leads to inflationary pressure. And we also have credit rating and investment confidence. I made mention this when I started. Ghana, when it comes to credit rating, we are not doing well, very bad. the debt to GDP ratio per the normal stretch was supposed to be 70%, and it should not exceed 70%. The normal should be between 30% to 60% when you are doing public sector. Immediately you exceed 70%, it means that you have crossed the red line. So and Ghana have even double that. So our credit rating is poor. Investors don't have confidence in Ghana again. Ghana is a very risky country to invest. That's why we're saying that high public debt levels can effectively impact economic credit rating, making borrowing more expensive and potentially leading to a loss of what? Investors' confidence. That is basically what is happening currently in Ghana. Please, I'll pause here. If you have a question, I'll take it before I continue. Before I continue, please. Or else I'll proceed with government grants and international governmental transfers in relation to local government. Please, can I proceed?
Yes, sir.
Okay, so government grants, as which is what you call very common. This we are referring to funds provided by a high level of government. For example, the central government providing any grants to a local authority or the local government, which in that particular case, if the local government is not doing well, the central government can give a grant or transfer a grant to support the local government. And when we're seeking the local government, we're looking at the district, that is the MMDAs, for specific purposes like irrigation, health, infrastructure, or welfare programs. So we also have intergovernmental transfers, and this includes both conditions and conditionalities. Transfer of resources from central government to local government to help meet their fiscal responsibilities. So what this means is that some of the transfers, there can be conditions attached to them that you have to follow this condition. If you breach the condition, it means that you are required to pay back the grant. Or there are some of the transfers of the grant that require no conditions. And a clear example, let me use IMF for example. When they give us conditionalities, tell us how you are going to manage your debts. Or probably they'll say, some time ago, the Ministry of Finance said the government payroll have what? Is full. It's because of the conditionalities from the IMF. Don't employ, public sector, don't employ. We are going to give you this transfer or this amount. So the central government can transfer to the local government and give conditions attached to those transfers. And some of the transfers can also go without what? Conditions. So it's either you stay, those with conditions, you stay and you don't breach it. And those without conditions, you can spend anyhow you want. So let's look at some the implications on some of these instances, where I want us to look at the local development. Because these grants and transfers enable the local government to provide essential service and infrastructure development, social welfare programs, because the local people, maybe if they want to build, I will always make reference to our politicians, whereby we can say we have able to build this number of toilets, or we are able to do this. Because these grant and transfers are to help the local government to provide these services. Maybe roads. Recently, the government talked about how they will do the roads and all those kind of stuff. Or social welfare programs. That will help without overburdening the local taxpayers. So that is one of the implications. Another one is the fiscal stability. Which states that, or basically is transfers that can help equalize or try to the financial resources among different regions and promote what balance of regional development and reducing economic disparities. So the central government can also transfer to the local government in order to achieve this balance. We have the independency risks. That's over-relying on central government transfers can reduce local government fiscal autonomy and accountability, because if they don't generate their their own internal generated funds and they are just relying on the central government, it's very risky. What if the central government is unable to provide? That's why we're saying that potentially leads to what inefficiency and misallocation of resources. So please, I will pause here. If you have a question, we'll look at it and we'll now dwell into the most significant. Some of these are past questions. Actually, that's what you'll be getting. They will ask you importance or significance of taxation, or taxation as a fiscal tool. And at this point, the reason why we actually want us to understand what fiscal policy is, the fiscal policy, monetary policies comes to look at the two, the discretionary and then the automatic stabilizers and all those. It's because of this, because you will get the question where the examiner is requiring you to explain how taxation can be used as a fiscal tool. That's how taxation can be used as a fiscal tool. And if you have asked, please, if you have a question, let me know before I proceed. Or if I can continue, let me get a response from you. Hello. Please, can I continue, or you have a question for me?
Sir.
Yes.
Please, you just mentioned that there can be a question of how how does taxation play a role in fiscal policy? Can you come out with that statement again, just to get a clarity on the question?
No, I'm saying that the examiner can ask you to explain how taxation can be used as a fiscal tool. And that is what basically we are going to look at now. That's what I'm saying, that let's pay attention as we move into these areas, because these areas are highly examinable places.
Yes, please.
So please, can I move on?
Yes, sir.
Okay. So when this case is presented to you, then we'll need to understand what fiscal policy is, or the understanding, because the examiner will always want to be in a layman's shoe, that he doesn't understand what fiscal policy is. So we are required as students to introduce And basically, we have something we call professional marks. When you introduce 1 mark, so you are supposed to tell the examiner what fiscal policy is. So as I explained, fiscal policy is how government uses her revenue and expenditure activities in a bid to control the behavior or the direction of the economy. How government uses her revenue and expenses activity in a bid to what? To influence the behavior and the direction of the economy. And I made mention the main instrument of fiscal policy is the government budget, because the government budget is a blueprint of government expected revenue and expected expenditure in a financial year. So in the budget, we know how much government is going to generate. We know how government is going to finance its activities. So taxation plays a critical role in fiscal policy, since the major source of revenue for government comes from taxation. The major source of revenue comes from taxation. So government can easily direct the economy or the behavior of the economy through taxation. So let's look at how government can do that. That's economic importance of taxation. The question I asked. So you have to take note. I see what they do these days is that they have actually there are no new questions. They just have to turn it to massages and bring the same question back. So you can get economic importance of taxation, or taxation as economic tool, or some objectives of fiscal policies using taxation. Is the same thing the examiner wants you to write. It's the same thing the examiner wants you to write. So let's take note. Economic importance of taxation, that is one. Or taxation as economic tool, or some of the objectives of fiscal policy using taxation, is the same question. So how do you respond to this during the exams? You have to go through these procedures. One is government, through taxation, government raise revenue for economic growth and development. Government raise revenue for economic growth and development through taxation. Taxation alone contributes 70 to 80% of the total government revenue. And when we talk about this, it is being divided. We have the indirect tax and we have the direct tax. And we can say that the indirect tax contribute about 50 to 55% of the total tax revenue. So basically, that is one of the economic importance, or the ways government can use taxation as a fiscal policy to raise revenue for government in terms of economic growth and development. 2, to protect infant industries. Because we are in a century that encourages international trade. So governments can try to impose heavy import duties. For example, if government want to encourage tanker vehicles, he can impose heavy import duties in relation to maybe any cars that comes into the country. So it will make it very difficult to import cars into the country. That will help Kantanka for Ghanaians to patronize Kantanka product or vehicles. In a way, trying to protect this infant industry like Kantanka, because Kantanka cannot compete with Toyota. He cannot. So it is a way government can use taxation, try to what? To change the direction. And that is why we are saying that one of them is what? Government does that just to protect the infant industries. And that is a typical example I just gave. This has, however, not been achieved because of low quality product. Because maybe some of the product that if government probably institute these heavy import duties, the local industries will not be able to get quality material to produce. Because maybe you are looking for a particular car that maybe Kantanka is unable to get that quality material to produce the car that will meet your taste. So it makes it very difficult for government to achieve this as a fiscal tool. And lack of raw materials is also a challenge. Low level of technology, because now we are saying that we're going to bring electric vehicles. So if we actually institute these heavy import duties, how many Ghanaian automobile companies will be able to produce electric vehicles? So it means that we'll be lacking of lack of raw materials, low level of technology, and high cost of what? Capital. That makes it very difficult for government to actually protect infant industries using taxation. Another point you can talk about is to arrest unemployment. To arrest unemployment. How would government do that? Government can reduce taxes on income that myself and you earn, which will increase our disposable income. And it will tend or increase what? Our demand. We will demand more. And it will what? Boost production. Because if we demand more, the businesses get more income, they make profit, and they invest that profit into their business, which will end what? If the productivity increase or production is boosted, more people will be required to do the work, hence reducing unemployment. Or the taxes on input can be reduced to achieve the same effect. So it's either government look at it from the disposable income side, or he look at it from the input, where if manufacturing companies goes to buy the material, the input, then the prices, there will be subsidy. So if they buy at a lower cost, they come and produce. They are able to produce and expand their production. They will require more hands to do the work. At the end, they'll employ more, hence reducing unemployment. So that is how government can use taxation as a fiscal policy or a fiscal tool. The three is 4 is to what? To combat inflation. To combat if there's inflation in the economy, government can use taxation as a fiscal tool. And when we are saying to combat inflation, we are looking at two angles. One is the demand pool and the cost pool. The demand pool and the cost pool. What is meant by the demand pool? The demand pool, we are looking at inflation from the demand side. That is as a result of excess demand. So in other words, we are looking at aggregate demand exceeding what? Aggregate supply. So if there is excess demand, then government, it means that we have more money with us, myself and you, we have more money. So how will government do that? Government have to what? Tax us more. You have to impose what? Heavy tax on our disposable income. Gets to reduce it. If you reduce it, it will indirectly what? Reduce the excess demand. So that is the demand side. And this is not used because high income taxes are not only immoral, but also what? Politically unwise. Besides, the formal sector is small as compared to the informal sector, because GRA, I can tell you for a fact, it is very challenging if it comes to what? Taxation of the informal sector. Because myself and you, controller pay us, or a company which the GRA charge them to take the taxes, withhold this PAYE and pay to them. Myself and you were deducted, will pay the tax at source. But somebody at Abosokai or Kokompe selling spare parts or something, he's not even registered with the GRA. How is he going to pay tax? So you see, so that is the demand side. Let's look at the cost pool. Let's look at the cost side. And this, we are looking at the inflation side, which is from the supply side. The supply side. And how will government do that? Government can reduce the tax on input of production. That is to grant what? Subsidy on this input. So if government grant a subsidy on input, it means that the businesses can buy this input at a lower prices. And when they buy it at a lower prices, they came and they bring it and they produce, which will end up what? Increasing their what? Their production and supply. Hence, reducing what? Prices. So if you are asked the question how government can use taxation as a fiscal tool, then you mentioned to combat inflation, you need to tell the examiner the two sides, that the demand side and the what? The cost side. The demand pool and the cost push. You have to try to explain the two sides. Okay, so let's look at the next point, which is saying that to prevent dumping. This phenomena is where a foreign seller sells goods and services at a higher price in her own country other than the foreign country. For example, let's say a foreign supplier in the US sell a particular goods or service at a higher price. When it comes to Ghana, he gets sell it at a lower price, because the aim is what? To kill competition in that country in order to gain monopoly in the future. So to prevent dumping, basically that phenomenon is talking about where foreigners sell goods and services at a lower price in their country, that is the foreign country, but at a lower price in, for example, Ghana. And the main purpose or the essence is what? To kill competition, so that in the future they can enjoy or gain monopoly. Prevention of dumping can be achieved by increasing the tax on such import heavily. So please, I'll pause here if you have any question, because I've explained many of them. I think it gets left with some two. Those ones, I think I've explained about 5 or 6 points. If you have any question, let me know and let me look at it before we move on. So please, that's what I'm saying. Take note of this area. The first one, what? The first one is what? Taxation as economic tool. The second part we are not coming is what? Tax incentives as economic what? Tax incentive as a tool of fiscal policy. Tax incentive as a tool of fiscal policy. They are different. Please, I'll pause here. If you have a question, let me have it, and then before we move on. Hello. Hello.
Yes, sir.
Yeah, is there any question for me, or I can move on?
So you can move on.
Okay. So if I just want to get a response from you, if let's say if the principle of tax paper is today, and you have been asked to explain how the government of Ghana, or yes, the government of Ghana can use taxation as economic tool or as a fiscal tool, what would be your response? Or in the simple put, economic importance of taxation. What will you say? You can just give me the point. I just want to get a feedback as to whether or not we are all on the same page.
Okay, sir.
Okay.
And so I think the first thing we can talk about is the using taxation to address unemployment.
Okay.
To also protect infant industry.
Yes, to protect infant industry. Okay, that's two.
And to raise revenue for government economic growth and development agenda.
Okay, that's good.
And then also controlling inflation, both
Good.
from the demand side and then also from the supply side.
To prevent dumping.
Yes, to prevent dumping. That's excellent.
So
Yes.
can you also say to redistribute income?
To
Or it's not part of it?
To redistribute income, it will be social importance.
Oh, okay. This is economic importance.
Yes.
Okay.
Yes. Please, can I move on?
Yes, sir.
Okay. So now let's look at tax incentive as a tool of fiscal policy. Tax incentive as a tool of fiscal policy. Tax incentives. Please, let's try to mute if we are not asking questions. I beg. So we're looking at tax incentive as a tool of fiscal policy. And I'm saying that first of all, we need to understand what tax incentives are. And tax incentives are, by way, are tax rebates, lower tax rate, tax concession, tax exemptions that is being instituted or incorporated in the tax law to what? To help businesses reduces their tax burden. So it means that when we are saying that how will government use tax incentives as a tool of fiscal policy, we are looking at how government is going to use this tax rebate, this lower tax rate, tax concession, and tax exemption available for businesses to be able to use that as economic tool or as what? A tool of fiscal policy. For example, you heard what you call all the political parties saying that, oh, when I come, I'm going to scrap the e-levy, the bed tax, I'm going to scrap it, I'm going to give tax amnesty to Ghanaians. What they are doing, they are trying to use the tax incentives as a tool of fiscal policy. Please, all together. So even if in the exams, when they come and you forget, don't forget these politicians that sing every day. So please, when we are saying tax rebate, what does tax rebate means? Tax rebate, it means that having a discount on the tax rate. For example, if you are a tax, a normal, per the Income Tax Act 896, a normal business is required to pay tax at, your corporate income tax should be 25%. Now, we are saying that if you are into hospitality, that is hotel business and all those kind of businesses, your corporate income, it should be taxed at what? 22%. If you are into petroleum and mining, you are required to pay a corporate tax at 35%. So that is lower in what? Tax rate. Now, the tax rebate aspect has to do with maybe by the location of your business, you are getting a reduction. As I said, it is a discount. It is a discount by reason of what? Your location. For example, if the law says that if you are a manufacturing company and you are located in Accra and Tema, you have no tax rebate. It means that you will be required to pay the 20% because you will not get a discount. So that is the meaning of what? Tax rebate. I've already explained lower tax rate, where I made mention of hospitality, where you are required to pay corporate income tax rate of 22%. Normal business pay 25%. Petroleum and mining pay 35%. And when we are talking about tax concessions are more or less tax holidays. And the law says that if you are into cattle farming, you have a tax holidays of what? 10 years. 10 years tax holidays. But the law requires that within these 10 years, you pay tax at a rate of 1%. But recently, it's been instituted or changed to 5%. So that is the meaning of tax concession. Basically, the tax holidays. What is tax exemption? Tax exemption is basically an amount that is what? Or an individual that is being exempt from tax, from paying tax. And per our laws, it is only the minister responsible for finance who can exempt an individual or a person from payment of tax through the approval of parliament. That is why recently they were talking of if the tax exemption were granted these multinational companies. It was a challenge. It's a topical issue. So basically, that is the meaning of tax exemptions. So please, I just want us to get the concept, what it means. So if you are a tax student, you should know what tax rebate are. You should know what low tax rates are. You should know what tax concessions are. And you should also know what tax exemptions are. Please, all together. I want us to get.
sir.
Yes, sir.
I want us to get a concept before when I move on to this to discuss these tax incentives. We are all on the same page, and that is at Prof solution. The concept is the key, because if you don't get a concept and we try to go through past question, or we say go and then solve past question. You go and that past question is not there. You don't have the concept. You will not be able to produce, or you will not be able to write. So we want to, yes.
Okay. You made mention of the tax rebate. I can see lower tax rates also there.
Yes.
But from
Yes.
your definition, does it mean that with the tax rebate, it can be lower or higher than the approved rate that
No, it cannot
pertains
be
for
higher.
maybe it cannot be higher?
The
Okay.
rebate is a discount. It is a discount on the tax rate. So it will be a discount on the 25%.
Okay. I think when you were giving the example, you made mention of the hospitality being 22%, and you came to the oil companies or whatever 35.
Yes.
That's why I want to know that if the standard is 25 and one can go beyond it to 35 under the explanation of the rebate, then if you can throw more light on that aspect.
Yes, yes. So I think I was explaining the two simultaneously, the tax rebate and then the low tax rate. But when I was concluding, I drew the distinction clearly. Okay, so what I'm trying to say is that the rebate is a discount on the tax rate. For example, the normal tax rate, corporate tax rate is 25%. So when we're talking about tax rebate, there's no way that it can go beyond the 25. It will rather be less than the 25. It means that you have gotten a rebate. The reason being the location of your business. And the lower tax rate is the activity, the business you registered, what you are doing. For example, this is where the hospitality comes in. By way of you going into the hospitality industry, your corporate income tax will be taxed at 22%. By way of you going into petroleum and mining, your corporate income tax will be taxed at 35%. Please, I don't know how I've answered your question.
Yes, I'm okay now. Thank you.
Yeah, thank you too. So please, am I getting any other question or I can move on? If I can move on, let me get a response before I move on, please.
Please move on.
Okay, so let's now go into the how we are going to use tax incentives as a tool of fiscal policy. And one is location tax incentive. Location tax incentives. And the law says that if you are a manufacturing company, please watch, it's not any other company. If you are a manufacturing company and because you are a manufacturing company and your location where you are located matters when it comes to taxation. By the grace of God, when you are able to finish or pass the level 2 and you come to meet us at the final level, we'll look at tax planning. And we have variable of tax planning, and actually the location variable talks about this. Because when you are going to do tax planning, you must know where to locate your manufacturing company, because there are tax planning issues where you can be able to explore. So the reason why we are looking at this is because they are saying that we should use tax incentives as a tool of fiscal policy. It means that government is going to use tax incentives to direct the economy. And how can he use the tax incentive to direct the economy? One, he's saying that your location, he has something we call location tax incentives. That if you are a manufacturing company and you are located in a particular place, he will give you tax incentives. And what are these tax incentives? The law says that if you are a manufacturing company and you are located in Accra and Tema, there's no tax rebate for you. So what it means that you will not get any discount on the tax rate. If you are a normal business, you pay 25%. If you are that is when you are let's say, even if you are a manufacturing company in this context and you are located in Accra and Tema, you will not get the tax rebate. you will still be taxed at 25%. And when you are located outside Accra and Tema, you have a tax rebate of 25%. So it means that you get a discount of 20%, 25% on your corporate tax rate. That will be the discount you get. Now, the law again says that if you are located outside the Accra Tema and other regional capital, in simple terms, if you are located elsewhere, like Bunkrugu Yoyo, you have a tax rebate of 50%. I think somewhere when we were doing the time I was doing ICAG, somebody when they after the class, somebody a guy when they have their manufacturing company in I think outside in Sanwam side in Sanwam, wrote to the Commissioner General. He walked to the Commissioner General and tell him that where their business is located, they are not supposed to pay the required rate. They're supposed to get a discount of 25%. So GRA have to come into agreement with the guy and tell him that going forward, they can now apply it prospectively because it cannot be done retrospectively. So now, after you pass the principle of taxation, it is being required for you to practice because you get this knowledge, you pass, finish, you have to make good use of it. So that is the basic understanding, which a simple put, any manufacturing company located in Accra and Tema, there's no tax rebate. Any manufacturing company located outside Accra and Tema, that manufacturing company will be given a tax rebate of 25%. If the manufacturing company is located outside Accra and Tema and the regional capitals, that manufacturing company will get a tax rebate of 50%. So this is just to encourage what? Development and improve infrastructure in terms of what? The road, electricity, drinking water, among others. So please, that is one of the ways government can use tax incentive as a tool of fiscal policy. So please, I'll pause here. If you have a question, let me take it before I move to agro processing companies. Agro processing companies. Please, can I move on? Or you have a question?
Hello?
Yes, go ahead.
Yeah, I have a question.
Okay.
Yes, please. So reading from what you just said, if the company is cited, the manufacturing company is cited outside Accra and Tema and the regional capitals, so that includes the Bolgatangas, the Tamalis, which are regional capitals. Am I right?
Yes. Yes.
Okay.
That's why I mentioned the Bunkrugu Yoyo. The Bunkrugu Yoyo is in Tamale inside. It did that. It's in that inside. That's why I mentioned Bunkrugu Yoyo. If you guys finish and you come to the final level, or even I'm yet to see when we get to the computations, they can give you, it's mostly at the advanced level. They can give you a scenario with figures, and you have to compete. So you have to know that when they mention Bunkrugu Yoyo, you have to know that Bunkrugu Yoyo, because it's a manufacturing company and it's located at Bunkrugu Yoyo, and the Bunkrugu Yoyo is outside Accra Tema, and then the regional capitals, they have a tax rebate of what? 50%. So you have to calculate 50% on the tax rate, and that will be the discount on it before you use that one to calculate their what? Their corporate income tax. Those ones will be demonstrated to you when we get to areas that require computations. But I can state emphatically that it's being done at the advanced level. When we are doing tax planning, they can give you the data for you to do analysis and advise management whether or not, or which areas should they cite the manufacturing company. Please, I don't know whether I've answered your question.
Yes, sir. Thank you very much.
Okay, thank you too. Okay, if there's a question, I take it, or I move to agro-processing companies. Agro-processing companies. So agro-processing companies is just an extension. If the law is saying that if you are going into agro-processing, you have also incentives. And what are the tax incentives? We are saying that you have a tax concession, that is a tax holiday of what? The first 5 years. If you start your agro-processing business, for the first 5 years, you have tax holidays. And you only pay tax at the rate of what? That is why we call it concession. At a lower rate, that is 1%. And I may mention that now it is 5%. That is why it is concession. So it means that within that holiday period, you'll be required to pay a low, get something a little to the government of Ghana. So for those established in other regional capitals, that is outside Accra and Tema, and outside Northern Savannah Ecological Zone, the tax rate is 15%. That is after the what? The 5 years of operation. That this rate you apply it after you have exhausted your 5 years, because the law says that after the 5 years, when you start the first 5 years, that is what your holidays period. So after the 5 years, then if you are an agro-processing company and you are located or established in other regional capitals aside Accra and Tema, and aside Northern Savannah Ecological Zone, the tax rate, the corporate tax rate after the 5 years will be 15%. And those outside other regional capitals will be taxed at 10%. Others outside regional capitals will be taxed at 10%. And those in the Northern Savannah Ecological Zone, their chargeable income will be taxed at the rate of 5%. So those outside other regional capital will be taxed at 10%. Those in the Northern Savannah Ecological Zone will be taxed at 5%. So it starts from 15, 10, and 5. That is if you are agro-processing company. You have a tax holiday period of 5 years. After the 5 years, whichever place you are located, you'll be taxed at 15%, 10%, and 5% respectively. So we also have the activity tax incentives. Activity tax incentives. And that is, activity is basically the activity you are undertaking, the particular business you are registered to operate. You will get an incentive. So we call it the activity variable if we were looking at tax planning. Tax planning. Well, so tax planning, we have variables that make the tax planning very easy. We call it, the short form is late. We have the allocation variable, we have the activity variable, we have the time variable, and we have the entity variable. That's what I'm saying, that when you come to the final level, we'll look at this more into details. But now, for what you are supposed to know, you are supposed to know how this tax incentive can be used as a fiscal tool. And one is the activity tax incentives. And this arises where there exists what? Tax incentive in pursuing a particular activities, especially agriculture is the mainstay of what? The economy. And why are we saying what we call agriculture? The law says that the income of a cocoa farmer from cocoa is exempt from tax at our university. this one, we are always thinking income of cocoa farmer from cocoa is exempt from tax. That is section 7 of the Income Tax Act 896. When you go there, you get exempt incomes. And the income of a cocoa farmer from cocoa is exempt from tax is from section 7 of the Income Tax Act 896. So we're also looking at, let's say if you are registered as livestock business other than cattle, cash crop, you have 5 years tax holidays. Livestock other than cattle, cash, other than cattle, you have. If you are going into cash crop, you also have 5 years tax holidays. 5 years tax holidays. If you are going into cattle farming, you have 10 years tax holidays. But within this period, as I mentioned, 1, if you are into livestock other than cattle, 5 years holidays. If you are into cash crop, you have 5 years tax holidays. If you are into cattle rearing, or cattle farming, you have what? 10 years tax holidays. Within this concessional period, within these tax holidays, you are required, as I made mention initially, that this particular activities pursued was supposed to be taxed at 1%. 1%, and currently it's now been changed to 5%. So note, however, that as instructed in the Income Tax Act 2015 Act 896, a concessionary tax rate of 1% will be imposed during the holidays period. So in this case, it will be 5%. Okay. We have the free zone. It's also an area that the government have provided tax incentives in there, that government can use it as a fiscal tool. That government can use it to direct or influence the economy. And what are these tax incentives? We are saying that the Free Zone Act 1995 Act 504 says that if you are operating in the free zone for the first 10 years from the date of commencement, you will not be required to pay tax. That's what the act is saying. So it's a way of trying to influence people to go into the free zone. By way, government is trying to direct or influence the behavior of the economy. And then the income tax rate after the 10 years will be 15%. Will be 15%. And see, recently, Senior Ima posted what do you call a ruling by the Commissioner General. You know, initially, any dividend that is paid out of the free zone is exempt from tax. The normal instances, any shareholder that is paid dividend, that dividend is subject to withholding tax at 8%. So to encourage people to go into the free zone, it was being explained that any dividend that arises from the free zone to any shareholder is exempt from tax. And now GRA is of a position that Section 28 of the Free Zone Act 1995 of Act 508, that particular act is inconsistent with Section 136 of the Income Tax Act. And therefore, the Section 136 has repealed Section 28. In summary, it means that now, going forward, any dividend that is arised from the free zone is subject to tax. Please let me pause here and take questions before I move to social significance of taxation. This is the social importance of taxation. Please, I'll pause here and then take questions, please. Please, do you have any question for me? Or I can move on.
Yes, sir.
Please move on.
Okay. So now let's look at the social importance or social significance of taxation. I think one of us mentioned redistribution of income, real income. And I said that was the social importance of taxation. So redistribution of income is one of them. This is basically, as I made mention, the progressive taxation, in the sense that we want to tax those who are rich to help those who are poor. That's why we have the concept that pay as you earn. The more you pay, the more you earn, the more tax you pay. And the less you earn, the less tax you pay. That is what Ghana we are practicing right now. So it's way of what? Redistribution of what? Income, taken from the rich to help the poor. That's a simple put. 2, to cut down on the production and consumption of harmful goods. How do we do that? That's imposing what? Heavy excise duties are used on what? Import duties on what? Goods that is harmful. For example, if they tell you the amount of marijuana and those tobacco products, if they tell you the rate, the excise duties on those ones, you marvel, these alcoholic beverages. But my brother, it is still on the high. But the social importance of taxation is to cut down on the production and consumption of what? The harmful goods. And then the almighty checking of what do you call? I made mention of lifestyle here. It is social importance. This is done by imposing heavy taxes on goods consumed by the rich. So any those staying at Transaco and East Legon, if we know the goods they consume, then we can, by way, if government want to direct or influence the economy, he can impose heavy taxes on the goods that these particular individuals are consuming.
Hello, sir.
Mm-hmm.
Is this practicable in Ghana now?
My dear, it is not practical. See, Ghana, the things we have, they are on books. They are not. Ghana, you see, Ghana, honestly, I'm not a politician, but let me make this statement. We try to make the laws to favor the rich.
Mm.
Why am I saying that? You know, previously, the individual tax rate, which we term as the graduated tax rate,
yes,
the last bracket was 35%.
35, yeah.
They came and changed it to 30.
20.
They changed it to 30 simply because they were falling in that bracket.
Mm.
Then it didn't even take some time. Now they have introduced it back. Currently, the last bracket is 35.
Mm.
I'm sure the next government or the next time we hear, they'll bring it back to 30 again. Even they can even reduce it to 25. Because it is selfishness.
Mm.
Because we are saying that we are operating progressive. And the basic understanding is that those who earn more should pay more. so that will help those who are poor.
Yeah.
So this particular style, actually, you see, the reason why I'm saying that it is not practiced currently in Ghana is that it is very real, and then mostly it's used by the Commissioner General. Yes, for example, if I think there was a case in WA where Commissioner General, so in this particular case, what Commissioner General would do is that he will use the net worth method as a method. So actually, it was an insider who gave the information to Commissioner General, and then they sent their guys to go and study. So you see that you realize that Accra, those in Accra, you see that Commissioner General people will come and sit in your shop.
Yeah.
Just to monitor. There is a reason. So actually, he sent his guys to go and monitor. They were there. So they want to see in the good day, how much is the guy selling the food in the bad day. And you know, the funny thing, the guy was not smart. He only issue VAT invoice when he sells an amount of, let's say, 7,000, 8,000 those days. So when they sent him the letter to come and do the tax audit, that actually they were going to examine the VAT, what their main focus was the VAT.
Yeah.
They were not able to get proper documentation, so they had to call for his bank statement. That is for the enterprise. So it means that they are going to just look at the inflows that come in, plus whatever information they have physically. So that's the net worth method. So based on that, they will make an informed decision to determine the person's tax liability. And they slap in a huge tax. Meanwhile, on the real case, the guy was not making profit.
Yeah.
So it is not real. It's only the GRE sometimes that trigger this. But for it to be practicalized, my dear, it's not happening. If it is happening, like we'll all see it. The only instances where they were trying to use this one was when they said, let's say, if you use a vehicle capacity of some level. You remember they brought something like that out some time ago.
The luxury tax.
Come again?
The luxury tax.
Yes. So that it was also from this particular angle, just to take money from the rich. Aside that, what we have is in the books. We don't practice them. Please, I don't know whether I can move on.
Yes, sir.
Okay. So now, let's look at the next one. The next one is provision of social amenities. Provision of social amenities. Tax revenue could be used to provide social amenities to the citizenry. For example, extend electricity to areas that there's no electricity, maybe provide drinking water, build toilets and others. We can actually get those social amenities to communities by raising tax revenue to finance that. So please, that is the social importance of taxation. If there is a question, let me take it before we move to. So you see how I'm going through by the things. That's how the questions are going to come. First one was taxation as economic tool. Second was what? Tax incentive as fiscal policy. Do you get it? Now, we just look at the social significance of taxation or social importance of taxation. Now, we are now coming to look at the goal of public expenditure. Don't forget, we said fiscal policy is how government uses her revenue and expenditure activities. We are done with the revenue. We are now looking at the expenditure activities. and we have this expenditure activity, we said we have something we call the expansionary fiscal policy. Don't forget, we said government can increase its spending and reduce revenue. So that is a way of what? Government, that fiscal policy using spending. They can bring the question like that, or they can say the goal of public expenditure. That's another way they can bring the question. Or what is the positive effects of the expansionary fiscal policy? The reason why I'm bringing all this out is that if you check, when you finish, check the past questions, they will get massage it. Let's say if last year they said the goal of public expenditure, this year they will say that fiscal policy using spending. Next year they will say positive effect of expansionary fiscal policy. Do you get? So that's why I always want us to get whichever way it comes, we should be able to get it clearly and then attend the question. So please, let's go ahead and look at the positive effect of the expansionary fiscal policies. One is what? Provide social goals. Provide social goals. That is the theory of social goals is of primary importance to economic to the economy of public sector. That is what you call. So the social goals are divided into two headings. We have the social and economic overheads. So we are now trying to dip this into the public sector, which we are saying that these goals, social goals, are divided into two, where we are having the social and economic overhead. And the social overhead basically talks about expenditure that have to do with the hospitals, schools, colleges, and technical institutions. And then the economic overheads have to do with things like the roads and the highways, irrigation, and power projects. So government spend these monies to provide what? Social goals. Don't forget, we are looking at the goal of public expenditure or fiscal policy using spending, or positive effect of expansionary fiscal policy. So one is provide social goals, and I've explained the social goals are being separated or divided into two. We have the social and economic overhead, and why the social talks about the hospital, the schools, the colleges, and the technical institutions. And then the economic talks about overhead like this road and the highways. Please, that is that. Another one, government also spend to increase production. Increase production. So public spending contribute to production through a large number of public enterprises. That is both industries and agriculture. Government actually incur a lot of costs in the agriculture sector. That is irrigation and then power. Recently, there was a case where the government spent $12 million on the Palgo multi-purpose dam, where they are saying that there's nothing there. And the MPP are saying that the $12 million was actually the architectural work, the paperwork. So government actually spend on these things, on irrigation and power projects, seed farms, fertilizers, warehouses, federal roads. They are all things that government spend her money on. In the industrial sector, government also set up public enterprises like the steel plant and heavy electrical or engineering. So that is how government can come in to what? To increase production through spending, through public expenditure. So let's look at promote price stability. Promote price stability. Increase in public expenditure relieve the economy from depression. Because if the economy is very hard, so it means that, okay, so let me ask this question. If you were following me, so they are saying that if the economy is at depression, the government comes in to spend, to bring it to its equilibrium or to stabilize it. So in that case, is it discretionary fiscal policy or it is automatic stabilizers? Who can answer this for me? Is it discretionary fiscal policy or automatic stabilizers?
Discretionary.
Good. It's discretionary. Yes, that's it. Because we are saying that that one, it involves the government or policy makers. But the automatic stabilizers does not involve the intervention of the government or policy makers. It's the inbuilt mechanisms that bring the economy back to normal. In a simple put, it is the demand and supply that set the prices. So in this case, it's the discretionary. So government can actually come in to ensure that he spends to promote price stability, to bring the price to its normal. Government also spend to create employment. Expenditure is the most weapon to fight unemployment, because the level of employment depends on what? Upon aggregate demand. Because if we don't have a lot of what? Monies, there's no way that we are going to demand whatever the companies are producing. And if we don't demand, they will not what? Be able to sell and make profit. And if they don't make profit, there's no way they are going to employ. And if they don't employ, there's no way unemployment will reduce. Do you get it? So the government have to what? To now come in and spend, because he's spending simply to what? To create employment. And the government can influence either by making more expenditure or by sorting to what? Fiscal method. That is by raising the level of private expenditure, as the government tries to also what? Create employment opportunities. Do you get it? So the government can either create employment opportunities, or he takes the other level, that the private expenditure leg, where he has to maybe make price of input lower, or try to come in and give them subsidy, maybe fertilizers or those kind of stuff, to just encourage this particular objectives to be achieved. So when the question is asked, look at how you are going to try to explain this, that government spending will be able to result in creating employment. We have promote balanced growth. There's a tendency to use economic resources for further development of already developed regions. So government sometimes is required to use huge amount of what? Resources to place on developing certain regions that have already been devolved. That's why sometimes government cannot say that because Accra is already devolved, he is going to deprive them from their needed share of the national cake. Okay. So we have to reduce inequality of income. To reduce inequality of income. So government also ensure public spending, rather to reduce inequality of income. That is another objective of what? Public expenditure, public expenditure. So public expenditure on old age pensions. You know, we have is it LEAP program? There's a term for it where government support the poor, those who are aging over 70 or 60 years. They give them money for free. And then there's also free education and then free mid-year meals. Government spend in all this to make sure that he reduce the inequality, the income inequality, and it benefit the poor class in the community at the expense of the rich, So please, that is that. If you have a question on how, the goals of public expenditure or fiscal policy using spending or positive effect of expansionary fiscal policy, please, you can let me know, or else we move on to look at the constructionary fiscal policy. So you see, we have finished the positive effect of what? The expansionary. We are now looking at the adverse effect of what? The constructionary fiscal policy. The constructionary is saying that government should increase its tax revenue whilst reducing its spending. So let's look at that its effect on the economy. Please, you have to understand, because they can ask you the disadvantage. That this is the disadvantage, the advantage of the constructionary fiscal policy, and you should be able to explain, because the constructionary fiscal policy is saying that it involves increasing tax revenue whilst either maintaining or cutting the level of government spending. That will result in what? Bucket surplus. But Ghana will have never obtained bucket surplus before. Since I was born. So please, do you have any question, or I can move to the adverse effect of constructionary fiscal policy on businesses? Hello. Do you have any question for me?
Hi.
Can I move on, or you have a question?
Sir, please, you can move on.
Okay. So reduce. So we're looking at the effect of the constructional fiscal policy on businesses. That is to say that the constructional fiscal policy is government increasing tax revenue and reducing its spending. Let's look at how it will affect the businesses. And we're saying that reduce in the sales revenue and consequently profit. And it's true, because the constructional fiscal policy involves increasing in income tax rate, reducing our disposable income, like myself and you, our take home will reduce. If our take home reduce, our aggregate demand will fall. How we buy things will fall. If we used to spend 4,000 on our family budget, we cannot spend 4,000 again. We can spend 2,000. It means that our demand has fallen. With other factors of demand remaining what? The same, constant. Hence, reduction in disposable income will result in reduction in demand for goods and services. So you see, it means that the demand for goods and services that are provided by these businesses will fall, and it will affect their productivity. That is, in terms of sales, the reduction in sales revenue and then that of their profit. That's why we're saying that one of the points is reduction in sales revenue and consequently profit. The second point, reduction in profit that can be reinvested. Reduction in profit that can be reinvested. What does it mean? If we are saying that it is an adverse effect of the constructionary fiscal policy, it means that increase in the income tax rate will take more cash from the business. For example, the VAT now is what? 21%. Do you know the 15% initially was 12.5? They get brought to back. Oh, please, you didn't notice that. It was 12.5. Hello?
Yes, sir.
I hope we noticed that it was 12.5 and now they have changed it to 15 again.
Yes, please.
Yes, so it brings the total percentage to 21. Even if it is hospitality, it means to be 22%. That is so high on the part of what? The businesses. And the profit that they have made, they should have what? Reinvested, plow back. But all these taxes need to be paid. Even the VAT are supposed to pay irrespective of whether you have made profit or not. So the available cash for this on these businesses will reduce, and the cash available for their operations will also be reduced, and they cannot reinvest this income because the funds that they would have invested is being used to pay taxes. Firms have to raise monies from external sources with high costs, and it is also risky. They have no option than to go and borrow. Okay. Another one is restriction on flexibility in taking credit decision. You are saying that government should, the constructionary fiscal policies that increasing taxes and reducing government spending. So if government increase, let's say, high sales or consumption tax rate, that's the VAT, it reduces the business flexibility to grant credit, because the VAT, as I stated, is paid regardless of whether payment has to be received from customer or not. And business that grant credit for longer period, that the grace period for payment of the consumption taxes over the tax authority will have to what? To pay the amount from their own resources, or they have to borrow funds to pay. So you see how it has what? Actually restricted the ability in taking a credit decision because of the what? The high tax rate. Reducing profit of firms facing price elasticity demand. Price elasticity demand because of this indirect taxes, the VAT, the excise duties. If they are on the high side, the firm faces price elasticity demand and absorb what? The firm has to absorb the additional cost and risks, lowering what? Profit, or have to pass that to the consumer at the high price. That's why the indirect taxes, they have to push it to the consumer, myself and you, to pay. That is the what you call the VAT and the rest. Reduction in loanable funds. Reduction in loanable funds. Constructional fiscal policy reduce disposable income, as I mentioned, and households have a little left to save in the bank or invest in securities. So this go a long way to reduce our aggregate demand, resulting in what? Reduction in inflation, interest rate, and must drop, and cost of capital will be low. So please, if you have a question, let's look at it. This is just a summary of what we explained earlier. The constructional fiscal policy can be used to achieve the following objective by the government in general. So we are looking at economically to combat inflation through increasing taxes on income, protect infant industry through high income duties, prevent dumping through high import duties, conserve the foreign exchange position through high import duties, and to run government administration machinery. On the social side, that's to redistribute income, to cut down the production and consumption of harmful goods, to check lifestyle, to provide social amenities, and to rid society of unwanted goods from others. So please, that is what we call that. If you have a question, let me know. Let me know. I think I've already explained this, the automatic stabilizers. I've explained the automatic stabilizers where I'm saying that the economy, the inbuilt mechanisms have to stabilize the economy without the intervention of the government or policymakers or individuals. I've explained this, so you have it here. We have the discretionary, that is where the government have to intervene, or policymakers. So the expansionary fiscal policy. So please, I'm waiting for a question before I look at these two areas. Please, if you have a question, let me take it. Hello.
Yes, sir.
Any question for me?
Oh, just to ask, so with the handouts that is ready for sale, we have all of this in the handouts.
Yes, yes.
Okay.
All these things have been just pulled from Prof. Book.
Okay.
All these have been pulled from Prof. Book.
Sir, is this the only part? Is this the only class we are going to have about the fiscal policy? Or
Yes, I think that is what per the new syllabus, that's what we are supposed to look at. Maybe if you want us to look at other aspects, then we can take that up. Do you have any?
no.
Hello? Can you hear me?
So we
Yes,
can
sir.
hear you.
Come again.
We can hear you.
Yes. He was asking a question, so I want to.
Sir, yeah, sir. That is all that I know. I'm okay with this one. I'm okay with this one.
Yes. Okay. Okay. So that's what, when you, after the class, you can check on the new syllabus. This is what we are supposed to look at, and that's where the questions are, mostly the questions will be coming from. And because you have Prof manual, everything is being stated there clearly. After the class, you can go through and then make what you call refer to them. And I think Imatu will make the recording available as well.
All right, sir. Thank you.
Yeah, thank you. Please, can I proceed?
Yes, sir.
Okay, thank you. So let's look at the expansionary fiscal policies as I explained earlier. So you need to know this very well because it's an area that can come. And basically it is government increase in government expenditure and decrease in taxes that cause the government budget deficit to increase or its budget surplus to decrease. And it is known as fiscal loosening. We have instruments that are used in fiscal policies. Principle of taxation, anything is possible. They can ask you to mention the various instruments used in fiscal policies. And these are the things you should be telling the examiner, these ones. Government budgetary surplus and deficit, government expenditure, public debt, and taxation. Public debt and taxation. So I just want us to appreciate what we did today before we bring the class to an end. These are past questions, and we encourage that we get past questions from 2016 to date, principle of taxation, to solve each past question solution, and that you'll be able to understand and appreciate how the questions are being asked and how the questions are being answered. Because at the end, they're going to bring the same question back, but they'll just recycle them. So that is that, because this is a technique that Prof taught all of us. I think when I was doing Chartered Institute of Taxation exams, this was the strategy Prof Bills gave me, and then I actually used. I saw from 2017 to date that CIT past questions, and it actually worked. I didn't know the strategy well, but I guess, okay, let me practice what Boss Bill was telling me. And I did it, and then at long last, to my surprise, I have to get an award in that particular year. That was November 2022. So please, it works. After getting the concept, go and solve past questions. Go and solve past questions. You'll be able to appreciate how the questions are asked, how the questions are answered. So when you go to the exam hall, what we say is that immediately you are thinking in the exam hall, know that you are failing. We don't think in the exam hall, we write. So that is why this is the time for you to think, to go through the past questions. Sit down and then study. Go and answer the question. Go and see how they solve the past questions, and you'll be fine. So please, I just want us to just run through some of the sample of the past questions. I think these are in ICA website, and then Prof have also included this from topic to topic. When you get his book, each topic, like fiscal policy, you see all the past questions that ICA have asked, and then the solutions, and he have incorporated CIT questions into them. So it is a book that is a must-buy book. It's a must-buy book. Okay, all of us are using that book, so you see how important that book is. So please, let's look at November 2016, question 2, what the examiner was asking the students to do. They are saying the current level of government borrowing has become a topical issue for discussion, causing observers to wonder whether borrowing is good or bad. In the light of this, you are required to I. Evaluate the effects of borrowing on the economy of Ghana. Please, is that not what we did when we started? Or
Yes,
that is not what we're explaining?
Yeah, we've talked about that.
Yes. And the II is saying that discuss how taxation can be used as a fiscal tool in fiscal policy. Please, this one, they can bring it as discuss how or discuss the economic importance of taxation in fiscal policy. It's the same thing, or it's not the same thing?
It is.
Yes. So that's how they'll just take the question and massage them and bring them back. When you read the examiner's comments, the chief examiner, they'll tell you that if students don't read past questions, because these particular questions were examined last sitting, students didn't know, they were not able to pass. Those reading public sector, when you go and look at February, I think, and March 2020, is it 2024 or 2023? The chief examiner said 52% of the question that was asked in that sitting actually came from past questions. It was stated specifically at the chief examiner's report. So please, let's get the past questions. We have given you the knowledge. We have also shown you the way. The way is past questions and solutions. And bills have done that job for you. What you need is to just get the book. You have the concept in there. You have the past questions in there. Okay. Let's look at ICA May 2018. They are saying that the decision to change the level, composition, or timing of government expenditure or to vary the burden, the structure or frequency of the tax payment is a fiscal policy. Fiscal policies could be stabilizers, automatic stabilizers, or discretionary. Required. Explain automatic stabilizers and then discretionary fiscal policy. Is that not what we were talking just recently?
Yes, please.
Yes. You know, when they asked this question, that particular 2019, ICA 2019, ICA May 2018, students were explaining that automatic stabilizers are generators that they have done what like, or machinery that they were just trying to dangle around it because they didn't really understand what it means by automatic stabilizers. So from today, I want to believe that all of us here know what automatic stabilizers are and then how different that is from discretionary fiscal policy. Okay, let's look at this one. I think that's okay. We guess I have some few to look at. They are saying that public debts enable government to invest in critical areas of the economy where the capacity of tax revenue to undertake this project may be limited. In situations where printing additional money will disrupt the stability of the economy. It permits an equitable alignment of benefit and cost for long-term gestation project by shifting taxation away from current generation. Required. What is public debt? I have to explain what public debt. Get 5 marks, my brother, my sister. 5 marks, free public debt. 2, that's II. Critically examine public debt as an alternative to taxation and its effect on the economy. This is very simple. You just look at the the importance of public debt as an alternative, like government going for borrowing as an alternative of what? Imposing high taxes on the citizens. Please, all together.
Yes, sir.
Yes. And this one, 10 marks, free. 2019. What the question one? They were asking students, that economists. Let me just read the requirement. They said describe 5 purposes of taxation for an economy such as Ghana. In this instance, you can mix them, both the economic importance and the social importance.
Yeah.
You can mix them because they actually didn't specify.
Yeah.
A student that want to demonstrate much knowledge in taxation can actually segregate them, the economic importance and then the social importance. But my advice to students is that if you go to the exam hall and want to demonstrate your knowledge to say that you know, you end up failing. Okay? We encourage students to list more points and explain a little. Explain like 4 lines, 5 lines, and move on. Because if you want to tell the examiner, right, it's challenge this one, I studied and it really is chemo, let me write. You are wasting your time. List mention 1 point, 5 lines or 4 lines, you move on, 1 point. So we encourage that you mention more points and you explain a little. Why I was saying that? The examiner says if you mention 1 point, you get 1 mark. If you explain full page, and then let's say me, I explain full page, Emilia explained 5 lines. All of us will get half mark. Do you know why? Because examiners that are not senior examiners, when the mark finish, the chief examiner has to moderate the papers. So it's only the intelligent, the extraordinary students that will get an explanation 1 mark. But myself and you, what even we are explaining, we don't even know whether it is correct. Why should we waste time explaining full page to just get a half mark? So that is a technique for us all. The second question was to look at, explain the use and application of taxation as a tool of fiscal policy to stabilize the economy. You see, they repeated, if you check, this came in 2018, and they brought it back to 2019 in a different form. Or are they lying?
Sure, it's true.
Yes, they just changed it. And they brought it back. Look at 2018. Taxation is an important tool that helps and helps economies the world over, including those of the developing country. Required. Explain social impact of taxation in Ghana. So this one, if you mention the economy importance, you get 0 because they are specific. They say identify social importance of taxation. So please, I think that is what we were supposed to look at today. If there is a question, let me take it, or we bring the class to an end. Please, is there any question?
No, sir.
Okay, Boss Ima, over to you. Do you have any word for us?
Thank you very much, my colleague, Mr. Musa, for an excellent job done. For our family members, our colleagues on the call, I want to take your feedback on what Mr. Musa has taken us through today. Like we normally do, after each section, we try to do a recap. He has taken us through a number of past exam questions, very important. So let me hear from you. Emilia, Collins, Alberta, Derek, Osetutu, Rachel, Ramatu, Stanley, and Theophilus. At least a comment or two wouldn't be bad.
Okay, so
Okay.
we started with fiscal policy, and we explained what is fiscal policy to be, how government uses her revenue and expenditures to influence the behavior of the economy to achieve certain stated objectives, which include employment, curbing rural and urban imbalances, trying to control exchange rates or foreign exchange, and prevent dumping of unwanted goods or services. There are more. Then he explained that the budget or the national budget that is being done yearly is a way of identifying our revenue and expenditures, and that has three forms. Either we are having a budget surplus, which is contractionary, or a budget deficit, which is expansionary, or a balanced budget, which is a moderate policy. Yes, sir.
Okay, thank you very much for that attempt. Collins, do you want to add to that? Okay. Our course rep, Abeta.
Okay, sir. So we went further to discuss the various monetary policies and then that of fiscal as well. So basically, the two tools that government uses to control the economy is the fiscal and monetary, and then the fiscal aspect deals with the revenue expenditure, like my colleague mentioned. And then with the monetary policy, it's Bank of Ghana, they uses those two to control the money circulating in the economy. And then we discussed in details the impact of economic growth, inflation control, employment and exchange rate for the monetary policy, and then fiscal policy too. We mentioned the aggregate demand, economic stabilization, and so on and so forth. We also discussed the various monetary policy tools, the OMO, that's open market operations, the reserve requirement, and then the rest. And then we made mention of the types of the fiscal policy, the discretionary fiscal policy, and automatic stabilizers.
Okay.
I think I don't want to say so I should continue.
Yeah, I get it. So let's hear from Ramatu.
Okay, so I would say I'll begin from where our better ended, the types of fiscal policy. We mentioned two main types, which is the discretionary, which talks about deliberate changes in government spending and taxes to influence the economy. So with this particular type, we are saying that the government has influence. It deliberately does the changes to what is spent and taxes as well. But with the automatic stabilizer, it has no influence in it. It has to do with built-in mechanism that automatically adjusts the government spending and taxes to influence the economy. And I think we also looked at government grants and intergovernment transfers in relation to local government. And with the government grants, I think he made mention of the grants that government makes available to local government, like the MDAs, how do we call them? I think he cited examples and all that, and he also gave us implications of that. He said that with the local, it helps in local development, fiscal stability, and I think it also reduces over-reliance on central government, something like that. So that's what I got.
Okay, that's a good attempt. Thank you very much for that. Theophilus. Theophilus, if we can hear from you. Hello, Theophilus. Okay. Derek. Hello, Derek. Okay. Derek seemed not to be behind his device. Or say Tutu. Okay.
So they have said it all.
Or say Tutu, a man of few words. Okay, thank you. Madam Aivo. Hello, Madam Aivo. Okay. On this note, I think I want to say a big thank you to Mr. Musa for a great work done. And I want to encourage all of you that let's continue with the momentum, because we are on a journey to achieving something great. If you don't know, the pass rate for the paper, Principles of Taxation, is even lower than financial reporting, meaning a lot of people write a paper and they don't pass. Okay, but Boss Bill, myself, Mr. Musa, and Uncle Johnson are on a mission to ensure that you will secure your pass mark. Not only a pass mark, but to do very well and appreciate principles of taxation. So I encourage you to be regular at classes, to participate. Once the videos are shared, make sure you listen again, make your own note, grab a copy of Boss Bill's book on principles of taxation. If the Institute book on principles of taxation is also ready, please try as much as possible and grab one. So on this note, I want someone to give us the closing prayer. Who will do that? Osaiti to pray for us. Hello, Osaiti to.
Yeah, I'm here.
Please pray for us.
Okay. Our Heavenly Father, we thank you once again for a successful session. We are very grateful for the understanding that you've granted us, and we pray that during the examination time, you will not forsake us. As we are about to sleep or as we are about to learn, we pray that you be our guide and protector. These are many blessings we ask. In Jesus' mighty name, we pray. Amen.
Amen. Thank you and good night.
Amen. Good night.
Amen. Please, the group, sir, sorry, let me interrupt.
Yes.
So I wanted us to have a group like discussions instead of like the various groups you created, because some members are not active anymore. So if those who are very active, we can be meeting for group discussions, discussing past questions, because that's what you're doing in Amy.
Okay. Okay, so I'm not opposed to that. You can do that, but please forgive me.
Okay,
We
please.
have to skip tomorrow's group discussion. I guess you understand why.
Yes, sir.
We are not too well.
Yes, please. So forgive me for tomorrow. When I'm well, we'll find a way of catching up. Okay. So I'm
Then
not.
we can meet in and then maybe have the exam questions discussed. Some of the
No
past
problem.
questions.
I can wake up at 4 and share the link with you
Okay.
so that you can join
Okay.
and have your discussion.
Yeah, I think
That's
that
fine with
works.
me.
I
Please,
think it's
do we
not bad.
all agree?
Not really.
So Abeta, what's the tax tomorrow?
So far what we've done, tax administration and then the fiscal policies, we can go to the past questions and then answer the various questions under that.
Yeah, so tomorrow what time?
It was done, right, sir? The
Yeah,
time,
4 a.m.
yeah, 4 a.m.
Okay, I think I also have a different view on that. If we are going to solve past questions on maybe the previous topic, that's fine. But I feel in group discussions, normally we all benefit when we all read well before we meet. If not, it will be one-sided. So I suppose that either we leave what we treated today out so that some of us can go back to have a better reading on that, or we focus on only what we've done previously, as in the first topic, tax administration. Then everybody can also contribute better. If not, some of us might be quiet to listen to others, which I think wouldn't be too fair.
Okay.
Okay.
The questions are
From my
ready. You know, I
concern,
promise there's going to be a quiz on that topic.
Tax administration.
Yes, the questions are ready. Multiple choice questions, true or false, and the like. I'm just looking at how best to administer that question. Whether when I send a soft copy to you, you print and answer them and send it back to me. Initially, I was thinking I could administer it on our website, but you know, for this course, we are not registering on the website. It's a free session, so it looks like I may have to send you the
Tomorrow,
soft
Saturday,
copy.
you will paint. Okay. Okay. I'll buy you a painting book. Then what will you paint? Man.
I bet I want to buy a printing book, eh?
Sorry.
Okay, so let's take a final decision. Are we meeting tomorrow at 4 a.m. or you want us to skip and do our private studies around that time? Colleagues, what do you think?
Where are the men?
And nobody is speaking. We can skip and maybe have our personal studies tomorrow.
Yeah.
But I will try and wake everyone up. I'll call the group so that you all wake up. And then we can do our personal, yeah.
Okay, well,
And then if
that.
you can do the like you can go through the past questions yourself, and then later when we meet we discuss.
Good.
I think it'll work. Yeah.
Okay.
Thank you so
So
much.
we're waking you up 4 a.m. Please don't turn on your phone or put on silent.
Okay.